On that cheery note, we'll move to number 5.
Good morning. My name is Molly Fenner. I'm 11 years old and I'm from Long Island, New York. I have 2 questions today and I have put them in the form of a poem. Mr. Buffett, Mr. Munger, to get here we had to fly. I came to hear your thoughts if PetroChina was at an all-time high. My second regards a job that I know is just right for me. To be a seeds candy taster, my sisters and I would work for free.
Well, if you come up front, I'll put you to work.
Boyshams was for my mom, and my father loves his stock. I have a future tasting chocolate. This weekend has really rocked. Thank you very much. And really, what is your view on PetroChina?
If you come up at the break, Charlie and I will have taken all the pieces out of here that we like best, and you will get the rest. Charlie, do you have anything to add to that?
She wants to know what you think about PetroChina.
It's funny. I saw her out there in the shopping area, and I knew that she had PetroChina on her mind.
This was a question from the 2005 annual meeting. Berkshire had invested around $488 million in PetroChina between 2002 and 2003. Buffett sold that position in 2006 and 2007 with an internal rate of return surpassing 50%. After Buffett's answer, I will dive into that investment, but now let's hear what Buffett had to say.
We bought PetroChina a few years ago, again after reading the annual report. And fortunately, it was in English. It was the first stock, Chinese stock, and really the last. I mean, it won't necessarily be the last, but I mean, it's the only one that we've owned so far. We put about $400 million into it. At the time, and still, it produces about 3% of the world's oil, which is a lot of oil. It produces probably 80% or so as much as ExxonMobil will produce. And it's a huge company. Last year it earned $12 billion. Now, if you look at the Fortune 500 list, my guess is you won't find more than about 5 companies in the United States that earn $12 billion or more. So it's a major company. At the time we bought it, the total market value was $35 billion. So we bought it at about 3 times what it earned last year. It does not have unusual amounts of leverage. In the annual report, they say something which very, very few companies do say, but which I think is actually fairly important. They say they will pay out about 45% of the amount they earn. So if you can buy it at 3 times earnings, would turn out to be 3 times earnings, and you get 45% of 33%, you're getting a 15% yield on your cash yield on your investment. It's a very good annual report. Chinese government owns 90% of the company. We own 1.3%. If we vote with them, the 2 of us control the business. And it's a thought that hasn't occurred to them, but I'll keep pointing it out. But it's a very major business at a very, very attractive, at what was a very attractive price. Unfortunately, the government shares and our shares have the same economic interest, but they are classified differently, so that the government's 90% are called one thing and the 10% with the public are called H shares. And we have to report in Hong Kong when we own 10% of a company, or we did then, 10% of a company's shares. So unfortunately, the 10% applied only to the 10% of H shares, and so we had to reveal our ownership when we only had 1% of the economic interest in the company. So we would have bought more, but the price jumped up, and we are happy to have our 1.3% or whatever it is, and we think that they've done a good job in running the business. They've got large gas reserves, which they're starting to develop now. But it's a very major enterprise. It employs almost 500,000 people. And the interesting thing was, a few years ago, relatively few people in the investment world probably even thought about the fact that PetroChina was over there and was a much larger business than most of just about any oil company in the world, except for BP and ExxonMobil. Charlie, do you have any thoughts on that?
Yeah, it would be nice if this sort of thing happened all the time, but that hasn't been true in recent years.
But I should emphasize, the annual report of PetroChina, which, like I say, it's easy to read, understandable. They declare their policies. Anybody could get it. You can read it. We did not go over, and we never had any contact with the management before we bought the stock. We never attended an investor presentation or anything of the sort. It's right there in black and white in a report that anybody can get. And we just sit in the office and read those things, and we were able to put $400 million out that's now worth about $1.2 billion or something like that. It was interesting at the time. I think I'm right on this. At the time, Yukos, which is the big oil company in Russia, was probably far better known among the investment community in the United States than PetroChina. And I compared the two at the time. Thought to myself, would I rather have the money in Russia or have it in China? PetroChina, in my view, was far cheaper, and I felt that the economic climate was likely to be better in China. Would I have, if it had been selling at the same multiple as a U.S. domestic company, would I have regarded it as more attractive? No. There's some disadvantages always to being in a culture that you don't perfectly understand, or where tax laws can change, your ownership rules can change. But the discount at which PetroChina was selling compared to other international oil companies was in my view at the time ridiculous. So that's why we bought it. And we will have the candy available for you at the break. Number 6.
When Buffett decided to invest in PetroChina, the company was trading at 3 times last year's earnings, and their balance sheet looked quite alright. They had $10 billion in current assets and $53 billion in non-current assets, and their current liabilities were $13 billion, while their total liabilities were at only $20 billion. And at the time, they were making $8.4 billion in net income as well. And the most important part, as you've seen on the thumbnail, the company declared that they will pay 45% of their earnings as dividends. Buffett paid around 3 times earnings. So if they were to pay all of their earnings as dividends, the cash yield would be 33.3%. But they were paying 45% as dividends. So Buffett got around 15% cash yield, which is just incredible. Not only that, the capital appreciation was also a sight to behold. Their initial investment almost 10x'd by the time they sold it. Another tailwind for that investment was the oil prices. From Buffett's investment in 2002 and 3 to his exit in 2007 and 8, oil prices more than doubled. With the 2020 hindsight, we can clearly see that this was a no-brainer investment. Mr. Market had no idea about how to value PetroChina. It was worth about $100 billion, but was trading at $30 billion range. That is why Charlie Munger said,
Yeah, it would be nice if this sort of thing happened all the time, but that hasn't been true in recent years.
who wouldn't want easy investments like this? But the thing is, the world is filled with them. The reason Buffett and Munger don't see these kinds of opportunities very often is because of their size. They have to deploy billions of dollars at a time to invest. So opportunities like this one don't come up very often. Assuming you don't have the burden of finding places to put billions of dollars at a time, I would suggest checking my other videos where I covered more smaller businesses from Turkey. There was another question about PetroChina in the 2008 meeting as well. With that, I will be closing the video. I hope you liked the content. And if you did, please leave a like and subscribe.
Well, let's go on to number 9.
Harry Bagai, San Francisco. Mr. Buffett, I was reading recently in Fortune magazine that when you invested $500 million in PetroChina back in 2001 or 2002, all you did was read the annual report. Now, I was thinking that most professional investors with the kind of resources that you have would have liked to have done a lot more research and talk to management, maybe regulators, et cetera, et cetera. The question I have is what is it that you look for when you're reading an annual report like that? How is it that you were able to able to and did make an investment purely on the back of reading that report?
Yeah. Well, it was in 2002 and 2003, and the report came out in the spring, and I read it, and that's the only thing I ever did. I never contacted any management. I never got a brokerage report. I never asked for anybody's opinion. But what I did do was I came to the conclusion that the company, and it's not hard to understand crude oil production and refining and marketing and the chemical operation they have. I mean, you can do the same thing with Exxon or BP or any of them, and I do that with all. I look at them. And I came to the conclusion it's worth $100 billion, and then I checked the price and it was selling for $35 billion roughly. What's the sense of talking to management? I mean, basically, if you talk to management of almost every company, they'll say they think their stock's a wonderful buy, and they'll give you all the good stuff and skip over things that it just doesn't make any difference. Now, if I thought the company was worth $40 billion and had been selling for $35 billion, then at that point you have to start trying to refine your analysis more. But there's no reason to refine your analysis. I mean, I didn't need to know whether it was worth $97 billion or $103 billion if I was buying it at $35 billion. So any further refining of analysis would be a waste of time when what I should be doing is buying the stock. So we really like things that you don't have to carry out to 3 decimal places. If you have to carry it out to 3 decimal places, it's not a good idea. It was something like PetroChina. It's like if somebody walked in the door here and they weighed somewhere between 300 and 350 pounds, I might not know how much they weigh, but I would know they were fat. That's all I'm looking for, is something that's financially fat. And whether PetroChina weighed $95 billion or $105 billion didn't make much difference. It was selling for $35 billion. If it had been selling for 90, it would have made a difference. So if you can't make a decision on something like PetroChina off the figures, forget about going further. And that's basically what we did. It's a straightforward report, just like reading just like reading Chevrons or ConocoPhillips or anything like that, just as informative. We're going to learn more, by going out and deciding whether you thought they've got one huge field in China, whether the life of it was 13 years or 14 years or something of the sort. They should hit you between the eyes. Charlie?
Yeah, I would argue that we have lower due diligence expenses than anybody else in America, and that we have had less trouble because we had less expense. I know of an investment operation in America that pays over $200 billion a year to its 200 million. Yes, yeah. 200 million, pardon me, to every year to its accountants, a lot to help them with due diligence. And I think our operation is safer because we think like engineers. We want these margins of reliability, and they're trying to do something really difficult, which is to have fine-grained.
When we get a call on something like the Mars-Wrigley situation, if we don't know enough about Mars and Wrigley by this point, so that we have to go out, I still like to go out, and, of course, and sample all the bars. So we have a 15. I mean, I feel I owe that to the Berkshire shareholders, but I'm not going to look at their labor contracts or their leases or anything like that. If the value of Wrigley depends on a specific lease someplace or a specific commitment to this or that, or a given environmental problem, forget it. There are these overriding considerations that are enormously important, and then there's a whole lot of trivia that doesn't mean anything. That we have never made we've made plenty of big investment. I've made plenty of big investment mistakes. I've never made one, in my view, that would have been avoided by conventional due diligence. And we would have spent a lot of money, and we would have wasted a lot of time, and in some cases we would have missed deals simply because we wouldn't have committed fast enough. We have a significant advantage, and it gets bigger as we get bigger, because in terms of big deals, people rely more and more often on process, in that when people want to get a deal done and they want to know it's going to be done, they will come to us. I mean, the Mars people wanted to deal in terms of this financing aspect of the Wrigley situation. They only wanted to deal with Berkshire, and because they knew we didn't have any lawyers involved. I'll admit to this group, we didn't even have any directors involved. We we just, we got a call, it made sense, and we said yes. And when we say yes, we don't say yes with a material adverse change clause. We don't say yes if financing is available. We just say yes. So I can tell people when we make a deal that if we're going to have $6.5 billion available, it's going to be available, whether there's a nuclear bomb goes off in New York City, or whether there's a flu epidemic, or whether Ben Bernanke runs off to South America with Paris Hilton. That the check is going to clear. And if you're making a deal, the guy that wants the $6.5 billion, that assurance is worth something, and you really can't get anyplace else. You say, well, I'll do it, but I've got to have a due diligence team check this out and do all of that. So it's a real advantage to us, and I don't think there's any disadvantage to us.